welcome to my channel. Well, I've got some good news and some bad news. The good news is that interest rates are coming down and the yield curve is uninverting. The 2-year bond now pays 3.65% and the 10-year bond pays 0.06% more. It pays 3.71%. And so things are starting to line up the way they should be. The 10-year should always pay more than the 2-year. The bad news is that whenever the yield curve uninverts, it leads to a recession and stocks going down. So everybody was thrilled about the idea of interest rates going down. I predicted that it would be a nightmare when they did, and so far that seems to be the case as stocks are beginning to go into a free fall. How serious of a free fall is the question. Friday, they took a severe tumble, and it looked really bad. The question is, will we get a dead cat bounce on Monday? On Friday, we got good news on the unemployment rate as it went down a little bit, okay? But the bad news was on the non-farm payrolls, which did not come in as high as they thought it would. Looking at the unemployment rate, it previously was at 4.3% unemployed, and it came in at 4.2%. Which was what was forecast. So yay, it came in line. Isn't that a good thing? But it really was a minuscule difference when you look at it rounded to 3 places. The previous month unemployment rate, if you take it out to 3 places, was 4.26%, which rounds up to 4.3%. And this month's unemployment rate to 3 digits goes to 4.22%. So literally, the unemployment rate dropped by 0.04%. You know, you might as well say it stayed the same, which is still good because at least it didn't increase. What made the markets decide that the employment data was bad was the non-farm payrolls came in at 142,000 and 164,000 were forecast and were expected. Also, they revised the previous month's numbers down to 89,000. Okay, below 100,000, not good. And then this month it doesn't show like it's taking up any of the slack. So basically, the market decided to believe the non-farm payrolls more than they believed the unemployment number, simply because it was such a minuscule decrease of 0.04% if you carried it out to the 3rd digit. Do you ever feel like the unemployment rate sounds more positive than things you're actually seeing in society? Let me introduce you to the U6 unemployment rate, which many people are starting to call the real unemployment rate. Right now, it's at 7.9%, and it got slightly worse over the last month. So I want to count this as the unemployment rate. I can't even believe they divided in 2. This should simply be the real unemployment rate. And what it is, it's the percentage of the total workforce that is unemployed and actively seeking employment during the previous month, which agrees with the general unemployment rate that they're using. The way that it differs is that this figure also includes all persons marginally attached to the labor force, plus total employed part-time for economic reasons as a percent of the civilian labor force, plus all persons marginally attached to the labor force. So it includes underemployed people, which should be counted, in my opinion. I think this real U6 unemployment rate would give us a much better idea of what's going on with jobs. And then we have this weird exogenous exterior force that's affecting our stock market. and it's the Japan carry trade. The only important thing to know about it is when the United States cuts rates, which we're going to start doing, or when Japan raises interest rates, which they have every intention to continue doing, the Japan carry trade gets worse, which means it affects our stock market and it puts downward pressure on our stock market. I think part of the reason it's been taking such a long time for us to go into recession, we've been waiting to go into recession for a year or more. I think part of the reason for that is artificial intelligence has been holding up the market. But now we see chinks in the armor of artificial intelligence. You know, I was trading Nvidia when it was above 120 and flirting with 130, which was around the high point. I think it hit 134 or something at the high point. But now it's at 102. You know, if it goes below like 95, I think you're headed for the 80s. It wasn't only 6 months ago that it was in the 80s. 5 months ago, it was in the 80s. So it's gone up a lot. It's gone up, 20% in the last 6 months, even after this come down. The encouraging thing is right now it's at a double bottom at around 100 would be a double bottom on this chart. And its relative strength is only 37. That's not good. It looks like it wants to go a little bit lower to me. And it could well go into the 80s, I think. I think for it to go below 80, you would have to have such a monumental crash. It would be unbelievable. But it could happen if we have a monumental crash. But I wouldn't think it would go below the 80s much. I did a video where I speculated, fantasizing that could it go below 75. And now I'm seeing videos by YouTubers saying and wondering, could it go below 50, which I think is outrageous. But monumental crashes always go much further than they should go. So anything is possible with the stock market, and that's why I'm an active trader. Looking at the chart on Berkshire Hathaway, the BRKB shares, even the rotating stocks are starting to fail. And I'm so lucky I got out at the exact high point. That was more luck than science. And so I was very lucky getting out at 480. But you know how it is with water. Water rotates before it flushes, and you just wonder if the rotation to trying to get into stocks that weren't going down is just a prelude to a bigger, broader market flush, which is what it looks like right now. Berkshire Hathaway has gone up almost 15% in the last 6 months. But I'm not trading it now just because I do not trade stocks when you're in a market free fall. And these YouTubers that are coming online and bragging about how they're buying stocks under any condition in any weather, good luck with that. Berkshire Hathaway's relative strength is 57, which is still decent. And if I owned any stock during this time, if I was crazy enough to do that, it would be Berkshire Hathaway. But its relative strength of 57 is pretty decent given these awful market conditions. Then it's time to return to my old friend SQQQ, SQQQ. It's the fund I trade when there's a down market because you're triple leveraged on the 100 largest companies on the NASDAQ, which is the QQQ. You're shorting it and getting triple dollars for every dollar that you invest in. For every dollar it goes down, you make $3. And I held off. I said, no, I'm not going to trade this. I hate trading SQQQ, even though I've made hundreds of thousands of dollars trading this in down markets. But I hate down markets. I hate trading in down markets. And it really puts me in the wrong mindset for fruitful investing. But in a down market, in a free fall market, I want to say, you really have no choice, or at least I have no choice. But it's a day trade only in my mind. And I wasn't going to do it. And then, oops, I did it again. And I bought it late on Friday, and I ended up making a little bit of money by selling it in the aftermarket. It went up. I made like $1,100. But it's strictly a day trading fund in my mind. To do long term in this fund is to hold it overnight. And if you hold it 3 or 4 days, you're a long-term investor in SQQQ. It's just meant for day trading, and it's very volatile and it's very risky. I've been in this fund in downturns before, and it's very fruitful at those times. But it is very risky, and I can't recommend it. But I dislike trading it, but I'm crying all the way to the bank. And this may be one of those times. We will see Monday whether we're going to get a dead cat bounce or we have truly entered the gates of hell. What's really helped in my trading is the CBOE Volatility Index, better known as the VIX. Usually bear markets are much more volatile, and when the VIX goes up, it's really a measure of puts versus calls, that there's a lot more people betting that the market will go down. So it's a very bearish indicator. And my experience with it, it's very excellent when it goes above 20, that you're in a bear situation and probably it's time to short, at least in my mind. And the more it goes up, the more it's time to short. And you can see in this chart, just since August, it already spiked up to 40, then it came back down, and now it's on the way up again. This is not looking good. The prediction is it keeps going higher, or at least stays in the 20 to 30 range for a while. Shorts usually get really rocking and rolling, and I'm doing SQQQ then when it gets above 25. I'm probably solidly trading SQQQ at that point. And then we got good news and bad news. As far as commodities are concerned, as you look at the chart of the GSG, that's the GSCI Commodity Index Trust, the GSG, it shows that commodities have come down in the last 3 months. They've come down over 6%. So it's good news that commodities are coming down. That's good for inflation decreasing. The problem is that this tends to happen before a recession. The VIX is up, commodities are down, and artificial intelligence doesn't look like it can hold up the market up anymore for right now. So it's time to short. I hate to short, but I'm going to force myself to accept the money I make shorting and learn to live with it. I'll somehow get by. Thanks a lot for listening.
Close till I get up. Time is barely on our side. I don't wanna waste what's left.